Let's break it all down with Veronica Clark, Citigroup Global Markets economist. We thank you so much, Veronica, for joining us. Let's dive in here with what the markets seem to be interpreting. There is a difference between an outright recession, a contraction, and a slowdown in the economy. But it kind of seems like the markets, if you at least look at the sell-off we've seen in the equity market, are actively pricing in a recession. Are they right to do so?
I would say, the forward-looking nature of markets, we're always going to be one step ahead. I would say in the next 6 months or so, we're not worried about, recession risks for the near term. But I think markets are right to react to a much more hawkish Fed, and a Fed that might have to be even more hawkish than what's already priced. And that does raise, concerns of a steeper slowdown, especially as we're getting into 2023.
So where is I feel like when you look at inflation, you should have to parse it into two different categories. This post-war inflation of this commodity drive, higher food prices, and the pre-war inflation of, say, used cars or wages, for example. Is it fair to separate the two?
Yeah, I think you do need to look at these drivers of inflation that we had, going back a year ago that the Fed, of course, initially dismissed as transitory. And that was in things like used car prices and goods prices generally, which have been really strong. And there was some, expectation of maybe we'd reached peak inflation with the last print that we got for March, last CPI print. But we had CPI data last week, of course, for April. And I don't think, we can say that we're at peak inflation yet. We're really seeing that it's much more driven by services prices now. Inflation has become its own thing. It's not in these goods prices anymore.
Well, it's so interesting that we're talking about inflation and a recession as if they're tied at the hip, because it kind of feels like that was the case for Europe, arguably, and the idea that investors maybe didn't want to head to China because of the COVID lockdowns, but Europe in particular, it seemed like recession was a foregone case. If you start to see weakness in China and Europe, which we have already seen, is it guaranteed that it drags down the American economy with it?
Generally, we would say that the U.S. economy is a little bit more insular than some other countries around the world. But I wouldn't expect that, the rest of the world could be slowing and the U.S. is immune from that. So if we did see a steeper slowdown in growth in Asia or in Europe for whatever reason, I don't expect that the U.S. can continue for too long at, this abnormally strong growth pace.
Well, it's interesting that you say that, because it feels like that thought process, perhaps not yours, but for other market strategists and economists, the idea of the strength of the American economy rests with the strength of the American consumer. And I wonder to what extent the wealth effect plays into that, as more and more Americans see perhaps a higher wage increase, at least nominally. How does the wealth effect perhaps prevent some of that demand destruction?
Yeah, I would say that, the wealth effect of what we've seen, at least in asset markets, is probably pretty limited, at least for the time being, while the labor market is so strong. I do think that's the most important, driver of strong growth for the next 6 months or so. It's just that you really do have a really strong labor market. You've got a low unemployment rate. You have nominal labor incomes that are still outpacing inflation, actually, still rising at around 10%. And as long as that's the case, I think consumers will stay pretty healthy.
Interesting that you mentioned that. Let's talk about what are some of the drivers in terms of pressuring incomes, nominal or real. And that, of course, is food inflation, oil inflation. We're looking at $6 of gasoline per $6 of gas in California. And we're also looking at food prices globally at a record. Which is the bigger issue, higher food prices or higher oil prices?
Yeah, that's a good question. In terms of actual share of what consumers spend on, it would be food. And if we look at like CPI, that is a larger weight in CPI. Of course, it's probably easier to maybe shift away from consumption of energy if you use public transportation in some parts of the country than food. I would say that food inflation is somewhat more concerning.
Food inflation, I feel like the American consumer is even perhaps more insulated from that food inflation if you compare it to the likes of Egypt, for example, or even Latin America, where more of their disposable income goes to food. I have to ask Veronica about the stimulus effect. There was such a big consensus around the stimulus effect ending at the summer of 2021. We've seen that extend over a year. Is that all in the rearview mirror now?
Yeah, I mean, we did get a large boost from stimulus to consumer, pocketbooks in the U.S., and of course that is probably part of what's driving such strong inflation right now. We have, I mean, of course, stimulus has ended at this point, but consumers do still have, a good amount of savings. They do still have, room to grow, credit card balances, for instance. So there is still some momentum there, but you're probably not counting on that stimulus to drive future consumption too much at this point.